Hello, everybody, and sorry for the delayed start. And welcome to this Q3 2023 quarterly conference call. I'm Jeppe Kirk Bonde, the most copied popular investor on eToro. And yeah, if you want to use this presentation for anything, please go ahead and read the disclaimer here at the bottom carefully. So the agenda for this presentation is I'll go through my background, my investment strategy, what I have in the portfolio, and then finally I'll go through the many questions that I received in advance. And then if you still have any further questions, you can ask them at the end and also get an answer. The reason that so many people are copying me on eToro, among other factors, is that since 2013, I've had an average annual return on investments of above 25%, and also with a relatively good return to risk profile. If you wanted a higher return than that, you would effectively have to take on a lot more risk. My background is that I worked as a management consultant. I'm originally from Denmark and spent most of my career in London. Now I live in Dubai. And as a management consultant, I advised large tech companies, telecoms, aerospace and defense companies, some of the largest banks in the world. And the product I worked the most with was valuation. So calculating how much a company is really worth. And as I was working as a consultant, I was making more money than I was spending. And so I wanted to invest my money. Then I looked at what my pension fund had to offer, what my bank had to offer, and I was quite unimpressed. My pension fund, for instance, was only investing in Danish companies, Danish projects, and Danish government bonds and corporate bonds. So that was really very poorly diversified, I thought, and with quite high fees. Then I compared all the different platforms to see, how good is the website, the app, what instruments are available, what are the prices and the fees, how is this platform developing over time, what features are there, and so forth. And then by weighing all of those, I identified eToro as the best platform for me. And then I started investing on eToro. And then as I continued to do very well, more and more people, including my family members and friends and so forth, started copying me. And in 2018, I quit consulting to focus only on managing my portfolio. And yeah, then it's just continued to go really well since then. I don't do everything on my own. I have a great assistant that helps me, including with editing this video. I also have a good network of experts that I trust on different topics. So if I invest in something, I must either myself be an expert in it, for instance, by having worked with that industry as a management consultant, or I must know someone who is an expert in that industry, because otherwise I cannot understand the latest, greatest things fast enough. I need to get to the right insights quickly, and I need to be able to explain what I think and then get told back exactly what's wrong with my thinking so that I can adjust it quickly. I get great support from eToro whenever I have any questions or concerns. eToro is always really quick to help. And I visited the headquarters of eToro for the first time in June, and they also had some great talks there about how the platform can be, even better in the future. Then I subscribe to the best data tools, so I always have the latest, greatest data flowing automatically into my financial models. And finally, I'll highlight my three favorite experts, which are my three brothers. One of them, he's the CEO of a marketing and advertising company. One of them is an economist with the Danish Ministry of Finance, working on their biggest financial models. And the last one did his degree in computer science, focusing on artificial intelligence, worked with that for some years, and now is heavily involved in the effective altruism movement. And whenever I have any questions or concerns on these topics, then they are my go-to guys. My investment strategy is based on some principles that have been there all along. So I focus on macroeconomics, identifying and evaluating what kind of growth rates different pockets of the global capital markets can have. I look for mega trends. So these are trends that can grow by more than 10% per year for more than 10 years. I conduct fundamental analysis, really analyzing companies in detail carefully, understanding what their management teams are like, what the products are like, the services, what their financial statements look like, what their strategy is, what potential different strategies they could have in the future, how they're likely to be impacted by different technologies, what their competitors are like, what it's like to be a supplier, what's it like to be employed there, what's it like to be a customer of that company, and so forth. And that's all with an eye on making a valuation of the company, assessing what is this company really worth, and then I want to invest in companies that are worth a lot more than they cost. Many, I would say, investors say that that's what they do, but if you just talk to people that work in hedge funds and investment banks or listen to discussions in various places, it's just not what happens in general. The few people who actually bother to do correct fundamental analysis have the greatest returns. And I think that's been true for a long part of history, and it'll continue to be true. It's simply a difficult exercise that not that many wish to engage in. Then the most counterintuitive of my investment principles is the focus on the long term. Because of course, if you are always right about the short term, then the long term will take care of itself, because the long term is, after all, made up of a long series of short terms. But in reality, people that focus on the short term, they do not have higher investment returns in the short term. They have equal returns in the short term or worse, and then they also have much worse return in the long term. So there's simply alpha to be generated by focusing on the long term. Whether you are managing an investment portfolio or a company or your own life, if you focus on the things that you will really remember as having been important 10 years later, like, wow, those were the important things, and you focused on those and you got those things right. If you analyzed a company and you got the big 5 things correct, then that's much more important than those little minutia day-to-day and details of the last quarter and so forth. There's a great quote by Benjamin Graham, the mentor of Warren Buffett and the author of the famous book, The Intelligent Investor. He said that in the short term, the market is a voting machine. In the long term, a weighing machine. And that essentially means that in the short term, it's important what different people think and what they think other people think. But in the long term, if a company becomes very big and profitable and can reinvest in itself, buy other companies or hand out dividends, then it'll be very, very nice to own a large part of that company. Then I focus a lot on risk management. I diversify across different geographies, industries, and business models. I currently have 60 different investments. I don't have any that are making up more than 6% of the portfolio, and I hedge against tail risks. So these are risks that are unlikely to happen, but if they do happen, they could have a very big impact. And so for each of those, I always want to have at least one asset, ideally a few assets, that could perform very well if such a scenario was to occur. Finally, I focus on keeping the fees low. So I don't use any leverage. I don't trade any high fee instruments. I have a low trade frequency, and copyiers pay the same fees as I do. There's no extra fee for copying someone, whether you buy Apple directly or indirectly by copying me. It's the exact same fees. And, keeping the fees low is just a great way of squeezing a bit more profitability out of one's portfolio. Then there are some areas where I see great opportunities. I like companies that have organic growth. That means companies that can increase their prices, sell more products, but it does not include companies that are just growing via acquisitions. So sometimes I can read at the beginning of an annual report that we grew the company by 2% this year, but I know that's just because they acquired some other companies. Actually, the core business shrank by 4%. So it's not very impressive at all what they've accomplished. I like companies that are resilient. So that means companies that can do well in many scenarios, not just in a few, and ideally in some scenarios where others might not do so well. That's often companies that have strong balance sheets, companies that have strong competitive advantages, a big moat around their business, or an ability to build a moat in the future, or an ability to pierce someone else's moat. I like companies that are profitable, real value creators that are able to ideally reinvest that value into themselves to grow that value creation engine over time. Then I like to invest in companies when they have a new good strategy. It's not enough that a company says that they have a new strategy. I must see some real action that prove to me they're serious about that strategy. For instance, by investing in something, building something, selling off a part of the business, changing the name of the company, changing the CEO, and doing other real steps. That's not just a piece of paper. And of course, when a company has a new strategy, if it's a good one, the hope is that you can be buying the company at the price of the old strategy, but what you'll be getting is the company on the new strategy. Then I focus a lot on products that are getting better over time. A classic, you don't also have to predict the far future. Sometimes it's enough to know what's going on right now. A famous example of failing at that was when Steve Ballmer, the former CEO of Microsoft, he held the first iPhone in his hand, and he said that business customers will not like it. It doesn't have a keyboard. It's too expensive. I'm very comfortable with our position. And he was, of course, proven completely wrong by the massive success of the iPhone. But that was an example of holding the blockbuster product in your hand and simply not being able to see that this is the blockbuster product. And many people did that in recent years with Tesla and will likely continue to do that with other new great products that we'll see over the next decades. If you are a smart shopper who's able to buy the right products and not always running back to the store to return something because you bought the wrong product, you understand which features are important, which are not, which metrics actually tell you something about the products, which ones don't, what is a good deal, what's not a good deal. If you really understand products and services, then that's one piece of the puzzle you've managed to fit in. But if you don't understand products and services, then you cannot understand companies, and then you cannot understand the stocks behind those companies, and then you cannot really hope to do really, extraordinary well in the markets, I think. Then I like companies that are mission driven, not just because I sometimes believe in the mission, but because it can be a great way to attract the smartest, most hardworking people and keep them motivated without necessarily overpaying them. Although, of course, the smartest, most hardworking people will sometimes have some pretty decent salaries that our companies have to pay. There are other companies where the opposite is the case. The smartest, most hardworking people in those companies, they are getting demotivated over time and will be looking to quit, even to potentially get a lower salary. Whether a company is on one end or the other of that spectrum may not show up in the financial statements next quarter. It might even, it might show up, but it will be in reverse. So actually the company will be looking to look good in the short term, but will look much worse in the long term. And whether a company is on one end of the spectrum or the other, it will really matter in the long term. Then my portfolio on eToro is primarily and always has been a stock portfolio. I also have a property that I rent out, and many people who copy me perhaps have a property that they live in or rent out, and building a stock portfolio on eToro. And this makes very good sense because historically stocks and property have been the two best investment categories. If you had a pile of money 500 years ago and you had split it into five what I call it, like buckets of 20% each, invested in the 5 largest economies, and then repeated the exercise every 100 years, you would, over those 500 years, have made a real average annual return of 7%. If you'd invested in the US over the last circa 100 years, it would have been about equivalent. And so that's really a good sort of metric to have in your head. Property has been very good historically as well. Bonds have been okay. Commodities have not really done much, and currencies have historically been terrible. They are currently terrible and will probably in the future continue to be terrible. So whenever I have some cash, I usually like to get it shifted left in this portfolio and in this chart, and ideally into some stocks. Then when we look at the big drivers that drive global economic growth in the long term, I like to split it into the physical realm, the social realm, and the realm of technology. So in the physical realm, it's very important how many trees of different kinds we have where in the world, how much oil and gas is in the ground where, how much of the different metals and so forth. I also focus on life, animals, but chiefly humans, how many people are in different places, how are the demographics changing over time. The companies that have the right products for the right demographics in the right locations, of course, have an advantage. Then the realm in which the most value can be created or destroyed the fastest is the social realm. So if you have a piece of paper that proves that you own your house, or there are some numbers on a screen and some thoughts in people's head that prove that you own a stock, or maybe you have a dollar bill, all of these are just numbers on screens, pieces of paper, and thoughts in our heads. If we believe these have value, we can use them to trade with one another, to cooperate, and that trade and cooperation can help us create a lot of value. On the other hand, if we stop believing in these instruments, then all of that value creation can stop, and then that can, of course, cause prices to change very fast. But then why do anything have value? If you have a house, most people will say that obviously this house has value. It's made of bricks. You can live in it. But if everybody just wanted to go hiking and nobody wanted to live in houses, nobody wanted to look at houses, then a house would not have any value. And sometimes what we value changes over time. If something is changing at a rapid pace, then even if it's coming from a small part of a society somewhere, it can suddenly be everywhere and something that's on everybody's mind. And if a company is riding on the wave of, or perhaps even driving such an agenda, then it can, it can create something really extraordinary. Finally, in the realm of technology, the biggest long-term growth stories come from the changes in foundational technology. So going through the agricultural revolution to the industrial revolution, to getting the internal combustion engine, getting into the electric era, getting to the digital era, and now perhaps, like I said, the internet era, and then finally what we are seeing now, the artificial intelligence era. But besides those big ones, there are the medium-sized ones, and all the way down to the, day-to-day incremental innovation that takes place in companies and in households all around the world, where some companies are just doing things slightly better day by day, others are slowly getting into technical debt, falling behind on things. And whether a company is in one end or the other of that spectrum can certainly show itself in the financial statements some years down the line. And then from those big macroeconomic growth drivers, we can look at how the world economy looks today. So across the board, the world is not really growing at the great historic rates, but is staying a bit still. You can read different articles that choose to look at the glass as half full or glass empty. You know, maybe we are potentially heading into a mild recession, or we will avoid the worst and so forth. Unemployment is not that bad in the EU. It's actually better than it was before COVID. And in America, it's quite decent. And some of the countries that are not doing well, they have not been doing well for a long time. So it's not just, you know, short-term cyclical stuff we're dealing with in those countries. Interest rates have come up, you know, in some places from negative up to something. And that's obviously helping to bring inflation in check. And if you look at how inflation is priced in the 5, 10, and 30-year outlooks, it seems like the market is overall thinking that it's under control. While it's still too high in some places, it's going in the right direction. And while some would say that it you know, there could be some sticky components, that's not the weighted average that people are voting with their money right now. What people are saying with the money is that inflation will not be that bad for that long. Then there are some mega trends that I've identified as extra interesting. So if a company is driving or riding on the wave of one or more of these megatrends, then it's more likely to be found in my portfolio. So I'll start with the nice to haves. When we humans, we have it all, then we like to compete with one another in games and in who can have the better fashion. And hopefully one day we can have a world where this will take up a much larger share of wallet. And, you know, we can focus on this rather than all the grim things and the boring things. But the nice to haves can only stand on the shoulders of the need to haves. It doesn't matter whether you want to be happy or help your family or, you know, change the world. If you don't have your health, you can't do any of those things. So the companies that are delivering great breakthroughs for health, in health insurance, biotech, and so forth are to be found in the portfolio. And similarly, the companies that are providing the security that underpins everything. If you don't have security, then you cannot decide, you know, for yourself. Then finally, there are the enablers and accelerators. So these are the factors that are helping us do all these other things faster, better, cheaper. The companies that have made the biggest breakthroughs in artificial intelligence over the past years are to be found in the portfolio. I have been looking very closely at OpenAI ever since they were founded. Many people older than me, they had their big AI moment when Kasparov, he was defeated in chess to a Deep Blue. I had my personal big AI moment when OpenAI created their artificial intelligence for Dota and played against Dendi back in the day. And when I watched that, I saw, wow, this AI is able to play this super complex game with a high level of creativity, pulling off amazing bluffs. And that really proved to me, wow, OpenAI is going places. So when they made GPT-1, I was impressed. When GPT-2 came along, I was very excited for it. And, you know, talking with my brother, who is a computer scientist all the time. And as soon as Microsoft announced their agreement with OpenAI, I ramped up investments in Microsoft and also reduced Google. And that turned out to be a very good move at that point. The companies that will be making the best devices in the future that we will potentially all be using, I think are also to be found in the portfolio today. Then when you've identified a group of companies and you want to have an overview of them, then a great way is to look at the multiples. So this is an example of some of the largest companies in the world, the big US tech companies, Microsoft, Apple, Meta, Alphabet, and Amazon. And here we can see that in the top left chart that they all have very nice profit margins, 42% for Microsoft. But Amazon is lagging quite far behind. In terms of growth, they are all, you know, most all growing, but not at the rates we were used to, except for Amazon. And Apple and Meta are standing quite still. We'll get new numbers from Apple and Amazon here soon. These two top charts, the higher the better, because they're about profitability and growth. But the two bottom charts, the lower the better, because they're really about price. So we can see at the bottom left corner, we are paying $27 for every dollar of profit that Microsoft brings in. That's sort of decent. But for Amazon, we're paying $107 for every dollar of profit they bring in. So we would really only want to pay this much more for Amazon if we think that they can sustain or maybe even bolster this growth rate and grow for longer, and or potentially improve their profit margins. Otherwise, we wouldn't want to be paying that much more for Amazon. And similarly, we can see we're paying $11 for every dollar of revenue that Microsoft is getting, but only $3 for Amazon. But Microsoft is also getting a lot more profitability out of every dollar of revenue. So that's sort of a way to get a good quick overview using the multiples. I usually look at big data tables all day. That's maybe 2/3 of the day. I look at big data tables. They look something like this. All of the data tables either come automatically in from all the data providers, or they are done manually by myself or my assistant, or they come in as subjective but numerical insights. So I might score a company saying, how much do I like the CEO on a scale from 1 to 10? Then it's subjective, but it's numerical. And so it can all be used to create financial models. I then make models to value the companies and rank them for how valuable they are compared to their costs. And I conduct risk scenarios. So how can they perform in different scenarios? And then I create a portfolio where I have a mix of companies that combined are the most valuable compared to what they cost at my risk appetite. When I then look at my models, I often see companies that could potentially be interesting. I then do a lot of deep research on those companies. For instance, my first investment was in Meta, or Facebook Inc., as they were called back then. And in analyzing Facebook in heavy detail, how they will do in each country, how they could do in the future, what new things they could add on and so forth, I got a great insight back then in social media marketing. I then, of course, thought to myself, I wonder which companies are doing social media marketing. Are they the smart companies? How valuable is this to them? And based off of that, I didn't just get a good understanding of Facebook and understood that this would become a very big, valuable company. I also got to update my models to account for social media marketing, to then understand how that would impact everybody else. And that turned out to be a big deal as well. And every company you analyze in detail will have some aspect of it that's unique, that nobody else does exactly like this company. And if you then get to understand that and then reapply that for how you look at everything else, that then changes how everybody else is scored. And then that might suddenly turn up a new company. But when you analyze that company, it might teach you something new. And if you then update all your models to account for that, then it might give you a new ranking. And then in doing that cycle again and again and again, and constantly figuring out what's the most important thing to be researching, what are the most important things I can be finding data on, or getting new insights on. And, then that cycle spins, and also turns out my investment decisions whenever there's a company that I think that I need to have more of or less of in the portfolio. And when you add up all those investment decisions over time, that of course becomes my portfolio. If you compare that portfolio with the US economy, we can see that in the US, it's not just one industry providing all the economic activity. There's economic activity across many different industries. So professional services, property, manufacturing, tech and health, and so forth. In my portfolio, I'm slightly more highly invested in tech, in climate and renewable energy, green tech, in financial services, in metal and mining, and in healthcare, including biotech. The largest assets in the portfolio now are UBS, Microsoft, Host Hotels and Resorts, Meta Platforms, and you can always see the full list of the companies, the currently 60 companies, on eToro, in the app, or on the website. It's fully available to see at all times. That was my presentation. Thanks everybody for watching this far. I'll now go through all the questions that I received in advance. And then afterwards, if you have any further questions, please write them in the chat, and then I'll go through those as well at the end. So firstly, what main factors influence the portfolio's performance in the last quarter? So in every quarter, there are effectively 3 categories of changes. The first is changes in price that happen to the different assets in the portfolio. Secondly, there are the changes that happen to the assets themselves. So, companies are almost living, breathing entities. They will be hiring people, firing people, launching new products and services, changing where they're going and so forth. So even if you don't buy or sell anything, companies will just be changing over time, and the same portfolio many years down the line might be completely different. Finally, there are the changes that I've made, so buying and selling. So if you look at the first factor in the quarter, the portfolio grew in value by 5%. So that's equal to 22% on an annualized basis, which is below my historical average, but still quite okay, I would say. The biggest climber has been Palantir, growing by almost 150%, and the biggest loser has been a Generac. Then in terms of the changes in the companies themselves, the biggest changes have really been in the companies making further changes to the already decent developments within artificial intelligence, as well as companies that are then responding to the rise of artificial intelligence or not responding. And then finally, there are the changes that I've made. So I've added EQT, the natural gas company. I've reduced my position on several different companies. I removed Corsair entirely, and I added quite a bit of a TSMC. What's a realistic return copyists can expect when copying you? So I explained earlier the long-term historical performance of stocks. So that was 7% average annual return. And I think that's likely for stocks on average in the future. Now, my historical return was the 25.3% average annual return. But it's important to state that past performance is not an indication or guarantee of future returns. A meteor could hit Earth tomorrow. There are many, many things that could happen that would, make the future very, very different from the past. I think that there are companies that are investing heavily into some technologies that can really, really create amazing value in the future. And I don't think that technology has slowed down. There are other factors that have slowed down. Population growth has slowed down. There are other, but I think that there are the things that are exponentially increasing are more than making up for that. So I think the future for a lot of companies, I think, will also be run over by this. There are a lot of companies that will not be able to generate any value because they are being outcompeted by some of these new technologies. But I think the right companies that can benefit the most from these new technologies, they will grow massively. And yeah, I'm very happy with what I have in the portfolio today that I think is the right ones for this. And as I'll learn more, I'll make the various changes along the way. What is your benchmark? So as I'm still the number one on eToro, I usually benchmark myself mostly against my former self. So I must make sure that I'm always the best investor that I can be, that I'm always expanding my network, expanding my number of data providers, getting everything to just work better, finding new angles, finding new companies to understand and so forth. But I also, of course, look at, as you saw in the beginning of the presentation, how other top investors are doing and have been doing, and how the S&P 500 is doing, how the Nasdaq is doing, and other indices. So those are also a benchmark for me. Why have you invested in hotel companies? So there are many different kinds of hotel companies. Some own hotels and others just slap a logo on top of a building and operate it. And those are very sort of different angles into the hotel business. And I picked some that own the hotels, and I think they're making some decent profits from the ownership of these hotels. And many of these hotels are in some great locations that you cannot just, replicate. So they have some potential to be very valuable, even while the other things are potentially not as valuable, or stay valuable even when many other things become abundant. Why have you invested in Ferrexpo? So Ferrexpo is a Ukrainian iron miner, and it's obviously suffered a lot from the Russia's attack on Ukraine. And I'm gonna probably keep my Ferrexpo stocks. They're producing a lot of value. It's not a very expensive company at all to be invested in, and hopefully Ukraine will win this war, and then they will have a brighter outlook, and potentially their products can be useful for the country in the restoration. And it's just very unfortunate that this whole thing has happened for everybody involved. How do you research the market? So I've provided somewhat of an answer to this in this presentation. I use my financial models to look at a vast amount of data that's then put together. I complement that with my own insights, and then I do a lot of research in order to always be learning more, so that I can, but my lens on the world is very much through my models, and then of course combined with what I see in my own life as well. Sometimes you get a good idea of just because you're talking to someone someplace. And Have you got any tips or white papers which were extremely useful when you started? So I started by getting my university degree in international business and politics, and then my master's in finance and strategic management, and a lot of financial certifications along the way that were generally required to be a consultant in banking. And I would say starting with the academic books is really the best way, because it enables you much better to then judge other things you hear along the way. If you start with the academic books, you'll immediately learn why technical analysis is useless. And then, then when you later on see someone using that, I don't have to listen to this. I don't have to listen to this. I can focus on this instead. And so that just speeds everything up. So I think if you want to be great at this, then start with the academic stuff to build the foundation. And a great book is the book called Valuation by Collar, Goodhart and Vessels. That's a book about just how to value companies, and that's really I would say the holy grail of investment, or the holy bible of investments. When adding new funds to the copy, shall I mark copy open trades again? So I cannot provide advice recommendations to what any individual should do. There could be different circumstances. Potentially someone is paying a very high interest on a loan and they should not even be investing. Maybe they should be paying off this loan instead or something. In general, when copying me, it's best to take copy open trades. So in the vast majority of cases, for most people, that's the most sensible thing to do when copying me. And that's the same when you are adding new funds. Then it's usually best to be taking copy open trades, because that way you invest in the same assets that I have invested in the same original percentages. And then when I sell something, then you sell that. And then when I buy something new, then you will buy that. And then it's sort of then it continues like that. At what percent should I set my stop loss? So stop loss can be set at a level where you know in advance that you would want to use your money differently. So if you already know if the markets drop by this much, you would want to take the money out and do something else with it. Then you could set a stop loss at that point, maybe minus 20%. And similarly, if you already know that if the market goes up by this much, I'm going to take out all the money and buy a boat, then you can say to take profit at that level. But otherwise, I personally never use stop loss. I think oftentimes it is almost like pre-programming a panic sell. So you say that, if the market goes down by 20%, then I'm going to sell everything. It's like, but what if the value of the companies has only gone down by 10%, but the prices go down by 20%? Now you're actually getting a discount on shares based on my valuation model. So I would want to buy more. So I would not want my, to have pre-grown then to automatically sell everything at a time when I should be buying more. So I think that's too often what happens with stop loss. And so that's why I don't use it personally. Why is Novatech showing minus 99.9%? So Novatech is a Russian company. It's been hit by sanctions. It was delisted from the London Stock Exchange, and this price is the price of the last trade that was executed before the sanctions were effectuated. And so many of us are just stuck with the Novatech shares. It's effectively a frozen asset. You cannot buy it, you cannot sell it, unless you live in specific countries. But even then, you cannot buy or sell it on eToro. And that's just unfortunate. When I first invested in this company, I assigned a 30% probability that this company would be taken over by the Russian government. And that's not exactly what happened, but to an extent it is what happened. And sometimes when you invest in companies, there's the risk that things go wrong. And that certainly happened with this particular stock. The positive thing was that I also invested in a lot of other companies that I expected would do very well in such a scenario. And they have then more than made up for this particular loss on Novatech. Is it better to invest everything now or to split it into multiple smaller investments? So that generally depends on, your financial situation. If some people, they have a lot of cash that's earning a very low interest, and they're not, then it might make sense to invest that immediately into a lot of stocks. It's usually good to have enough cash to meet any likely expenses. So you don't want to have to suddenly be selling a part of your portfolio or remortgaging a house or something just because you get a bill that you could have anticipated. But it's also not necessarily best to just have a very large amount of cash earning a low interest rate when stocks have historically performed much better. You should usually have at least a 5-year time horizon though for investing in stocks. If you're making steady salary, you know, earning more than you are spending, then it often makes good sense to take an amount maybe every month, maybe every 3 months, maybe just every year, and then invest that, and then just do it steadily, using what's called dollar cost averaging. So you just basically just keep investing and buying, and then, you know, over time you grow your portfolio that way, and then some years will be good, some years will be bad, and you'll, you know, then yeah, get the returns of the market plus whatever, you know, how much you put in. Do you plan to continue on eToro for the next 10 years? Yes, definitely. In terms of being ahead, I think my setup that I built and that I continue to build on is well ahead of my competitors that I, you know, that I sometimes talk to people from, and maybe I can keep accelerating that and keep making it better and just continue that. Maybe I can only be ahead for 5 years, maybe 10 years. Maybe I can be ahead for as long as Warren Buffett has. He has built something that others cannot just replicate, and even at age 92, he's still going very strong. When copying, are dividends automatically reinvested? So yes. So when this quarter we received 85 different dividend payments from companies in the portfolio, and these dividend are then received in the copy. When I then reinvest them, copiers automatically do the same. And when you see the return statistics, then it's also incorporated in there automatically, so you don't have to do like any extra calculations to get that the correct number. When you close a trade, does it automatically close mine, or do I have to do it myself? So that's also automatic. When I sell, then the people that copy, they at the same time make the exact same trade. So we all close that position. And then, you know, when we buy something new, we then all do that as well. So that's automatic. So you don't have to do one. If you just copy with open trades, then like you can add funds, or you can, you know, you can close it later, or you can also make manual changes, but fundamentally you don't have to do any of that. All of that good stuff is happening automatically. So that was the questions that I received in advance. Thank you very much to everybody who asked the questions. And yeah, now I'll just go through the ones that are in the chat. And yeah, if you have any more questions, please go ahead and write them in the chat now. Hi, are you interested in mental health companies? So it always, as an investor, I am often researching some kind of industry that is, you know, over here or over here, learning new things. I have researched several mental health companies, and I think it's a really, you know, important thing for the world. And so it's definitely something that I would like to have more of in the portfolio if the prices are right. Sometimes it can be, yeah, there can be some companies where the way to value them relies on some things that are so different that I cannot have the same level of competitive advantage that I can in some other things. And then I have to evaluate whether it's worth the research effort. Why is only 2 of your top 10 weighted stocks in your portfolio in the green? The top 10 make up some 34% of the total. I would have thought the higher you rate the change of a company, the more you would invest. So certainly the better I see the company as an investment, the more I would like to invest in it, including the risk factor. So there could be a company that I don't expect will have the highest return, but I think it really cancels out some other risks in the portfolio. So this company could do very well in a very bad scenario. So I might have that, even though I think across most scenarios, it will not be the highest return. And such a company could take up a large part of the portfolio. I could even have a company that I at some point think would not do well, but if it would save me and my portfolio in the worst of times, if there was a company that was somehow gonna, you know, save us in case of a meteor hitting, then obviously I would want to have that company. It's not correct that because a company is in the green, it's like going to be good in the future. You know, Amazon is either a good investment today or it isn't. It doesn't matter whether I invested in it, you know, 1 day ago, 5 years ago, whatever. Amazon doesn't go in and look at when I invested in it and keep track of whether Jeppe is in green or not. Either Amazon is good to have right now or it's not. So if we invested in Amazon now, that's either a good thing or a bad thing. And it doesn't matter whether the position is currently in green or in red. The way to really understand that is, you know, if you are sent to the kiosk by someone and you are asked, please go and buy me a 2-liter cola for $2. Then you come to the shop and then you say, sorry, we only have a $1 colas for $1. Or 1 liter colas for $1. So like, but the price is half, so it's gone down. Yeah, but the company is half as valuable and the price is half as much. So you're effectively getting the same deal. So you can have companies that have gone down a lot, but the value has also gone down. So they're not a better investment opportunity. You can have others where the company has become 5 times more valuable, but the price has only gone up by a factor 3. So it's actually an even greater investment today than it was back then. So it's generally not the right way to think that because a price has been going up or down in the past, that will have any bearing on the future. Would you consider increasing your position in Trek? So I generally don't comment on what I expect to buy or sell in the future, because that can obviously have an impact on then others going in and buying and selling and changing the prices before me, especially on the smaller companies where there's not so much liquidity in the stock. Me going in and buying and all of my copyists buying can actually end up having a quite big effect on the price. So yeah, I don't go out and say like, I plan on buying this tomorrow for those reasons. Okay, I think that was all the questions. If there are no further questions, then I would just like to say, thank you everybody for listening. Thank you for the questions in advance and for these questions. And if you have any further questions, you can always ask them as a comment to any of my posts on eToro. You can add me and write to me directly on LinkedIn or some of my other YouTube videos. And thank you everybody. And have another wonderful quarter, everybody.